I'm here today with Gennaro Faiola of Genworth Financial.
Hi Pam, how are you?
Hi, good. Thank you for coming and helping us answer some questions.
Oh, my pleasure. Thank you for having me.
Thank you. So you hear reverse mortgage and you hear equity line of credit. What's the difference between the two? Because both of them you're going to be pulling money out.
Right, great question, great question. A home equity line of credit is more of a traditional mortgage where you apply for the loan, you qualify based on your income and your credit worthiness. You get access to funds, but depending on how much money you take out, you have to pay that back on a monthly basis. With a reverse mortgage, you don't qualify with income or assets. It's based on your age and the value of the home, so credit is not an issue. And unlike a home equity line of credit, a reverse mortgage does not have any monthly payments. So the great thing is you don't have to worry about coming up short 1 month and therefore missing a payment because there are none. Now, the loan does come due at the end when you're no longer living in the property, but that's based on how long you decide you want to live in the property. And then at the end, the loan is settled when you either permanently move away, pass away, or ultimately sell the property.
Okay. So since I'm not 62, I can't even get a reverse mortgage, so I have to do the equity line.
Right,
if I want to get some money out of my home.
That's correct. Unfortunately, that is the one limitation, is that you do have to be a homeowner that's at least 62 years old or older.
Now, since you said I don't have to pay any payments if I am 62 and I got a reverse mortgage, how does that interest work on there? Because it keeps adding up, so am I going to eventually owe more than on my home than what it's worth?
Oh, another good question. That's a great point. The reverse mortgage does accrue interest on the principal and the balance that is out there, outstanding. But the great part about it is there is insurance called mortgage insurance premium, which is paid through FHA and HUD, and that essentially provides the guarantee and your insurance risk limitation to the lender, to the Genworth Financial, so that if in the event that the home ever is worth less than what's owed, the homeowner is not at risk and the lender is not at risk. It's paid for by the insurance. And that's one of the only loans that has that guarantee as part of it.
So when I would pass away, if I was 62 and I pass away after having a reverse mortgage, even if the house only could sell for $300, but I owed $350, my kids wouldn't have to worry about coming up with that $50,000. That's
correct, and I'm sure you're going to live a lot longer than 62, which I know. But yes, that in that example, if at ever the time of settlement, whatever that stage is, however long the reverse mortgage is taken out for, if you end up owing more on paper at that time of settlement than what the home is worth, the insurance covers the difference. So you and or your estate heirs would not be responsible.
That's great, Gennaro. The reverse mortgage is a little complicated.
It is.
And I think that what people need to do if they have any idea that they would like to have a reverse mortgage is that you should sit down with a professional advisor like yourself and really learn about the product.
Absolutely. We recommend that. Certainly we prefer that, an individual consultation, no cost or obligation, but we explain it thoroughly from A to Z and all the opportunities and components that a reverse mortgage has. And if it's a good fit, we look to move forward. If it's not, maybe we'll find another avenue.
Great. Thank you, Gennaro. If you have any questions, give Gennaro or myself a call. We'd be happy to help you.
Thank you so much. Good to see you.